I can see, Abraham, your microphone is on, although we couldn't get your, if you're speaking, then we can't hear you. I can see, Abraham, your microphone is on. Thank you, Drake Alanja, for joining us. Thank you, Jacinta Njenga, for becoming your presence. Abraham, let me know if you have any technical issues we can address. You can give us a status on the chat section, just to confirm if you are good to go. I can see your microphone is still active, Abraham, but I'm yet to, from my side, I'm yet to hear audio from your side. Okay, okay. Your microphone is enabled. Let me. Your microphone is enabled. I can see it's active, but the audio is not being transmitted. Maybe you can, if you have joined using your laptop, you can join with your phone also, and then use your phone to speak. I've also enabled your video, so usually if you have any issues with the video, just click on the control. Okay, let's give Abraham a second. Thank you, Gladys. I've seen your objective. You want to learn the best investments to ensure that you have enough cash flow to continue enjoying your life even in your retirement. Very good. I think I also share with you on that. I also want to learn that, exactly that. And you have specific interest in bonds. Now you are clear, Abraham. Oh, you have disappeared again. Are you using earphones? You can detach the earphones.
Okay, you can hear me now?
Yes, now you can hear you.
Okay, so if the earphones that's not working.
Yes, now I think the earphones are not working. Now you are very clear.
Okay.
Yeah, Gladys has already posted one of her objectives there. So as you introduce the session, you can also check on the charts.
Okay, okay, thank you. If you're able to share the slides kindly, from slide number 16.
Okay, let me get it for you.
So thank you all for joining in. We appreciate that you are here to get more knowledge, add on what you already have, and even prepare so much well for retirement and get to know. Retirement is not really the end, but it's more like a beginning of another journey. So we're here to prepare you that even if you are, even if you're 20 years, you're 30 years, you're 40 years, even if you're two years to retire, we all need to prepare as soon as we can. So our main objective is to make sure that you are well equipped in terms of planning for retirement, and that we are on the right track and the right journey, even as we move to that area where your employer will now have to let you go. And then now we're asking ourselves, what now? What now when you're no longer employable, no longer able to get employment anymore? So even as we wait for the slides to be shared, I'm at the chats trying to see if there's anyone who has sent anything in terms of what they expect or what is more of what they want to know most, so that I don't really miss a point. But in case a question pops in your head, please feel free to write on the chats and let us know how we can support in. Simon?
Yeah, it's opening. Just a second,
Okay.
it's open. So you
Okay,
said
so
I start from which slide?
from slide 16, number 16.
Slide number
I
16.
want the industry analysis and what trend is in terms of pension and the coverage in the industry.
You meant this one, eh? You can see my screen?
Yes. The next one?
Yeah.
Yes, thank you so much. So this is an industry snapshot of the pension industry. Thank you, Simon. So as of 2002, in Kenya, we had 100 billion of assets in pension. Grew to around 450 billion in 2010, and 2022 it was at around 1.5 trillion. Looking at the trend in the industry and the improved increased benefits in the NSSF, we anticipate that this might double in the next 2 years to around 3 trillion Kenyan shillings. So in pension, we have different stakeholders and different service providers. So this industry analysis has been given to us by these industry surveyors, and more so by the Retirement Benefits Authority, which is the major or the regulator in terms of pension schemes and pension savings in the country in Kenya currently. So we've seen this trend, and if you go country by country, you realize that the trend has been going higher and the amount is going higher and higher. So you have those retiring and picking up their money, but the amount keeps growing annually. Thank you, Jacinta. To know the strategies for preparing for retirement, to understand the best investment avenues that will help maintain your cash flows after retirement. Great, we'll get to that point. So the members as at currently is around 3.2 million Kenyans who are saving for their retirement. So the industry has fund managers, it has administrators, and it has custodians. So fund managers are usually the insurance companies, and as of custodians, we had 10 in 2001. We've seen a very slow trend in terms of growth for custodians. So currently we have 11. These are banks that are approved by KRA and RBA to keep pension funds. As administrators, as of 2001, we had very minimal. They were around 2 or 3. Currently, we have 31 administrators in the industry, which has really grown and improved in terms of competition and also service provision, trends in terms of technology and how members can access their benefits quickly. Moving on to the next slide. So why do employers provide for retirement benefit schemes for their members? Or why do we need a pension or retirement benefits? So we all do savings in terms of we save to secure our future or our retirement. In economics, we call it deferred consumption. So whatever you're able to consume right now, whatever you're able to feed on or use right now, you forego it. So retirement is more like a foregone alternative. You forego this consumption that I'll use it when I need it the most, when I no longer work, when I no longer have an income coming in. So we are doing these savings in terms of, even as we earn right now, even if whatever minimal it is you're earning, you need to defer some consumption, save it for the future. That when I'm not working, when I'm not employable anymore, I'll be able to have something to sustain me in terms of my retirement. You can just move forward. So the avenues for savings, you can either have your employer saving for you, whereby under a pension scheme, when there is an occupational pension scheme. I know most employers these days have these arrangements. So you can either save under an occupational pension scheme, you can save under an umbrella pension scheme, or you can set up your own individual personal pension scheme. So a personal pension scheme, you can have different providers giving you that avenue, but it helps you save for that retirement. So in pension, is not like I know in SACCOs we get dividends every month, dividends for the savings that we have every year. But for pension, whatever interest is earned every year is compounded. So the compounding interest is what enables us to actually save more and improve what we have in our pot. So the interest under every year is plowed back to whatever you had at savings and earned every year. So earning interest every year. So it improves on that in terms of savings and in terms of growing that fund to secure you in terms of retirement. So the more the years you spend in the scheme, and the more the years you invest with these funds, the more returns that you get, and the more your money grows. Well, I have a slide on that. We think when we get there, we'll get to see. We can just move forward, Simon. The slides are very quick, so I just want us to be quick with the slides. So savings culture in terms of the government, and also tax advantages in terms of savings. So even the president is really pushing in terms of savings culture that you don't have to eat all that you get as at now, but you can save some and eat later, so that when the economic times get hard, you are at least setting aside a fund, whether it's an emergency fund, whether it's a pension scheme, whether it's a savings in the SACCO, but at least you are saving something aside in terms of improving your retirement. Tax advantages. So for pensions, I understand the Kenyan law better, so I'll talk more about the Kenyan law. But I can catch on several countries I have an idea. So for every year you are in a pension scheme as a contributor, whether it's a personal scheme or an occupational pension scheme, you earn 60,000 Kenyan shillings tax free. At withdrawal, when you are retiring and you want to withdraw your money, you've earned 60,000 Kenyan shillings tax free. That 60,000 shillings is that when you're going to retirement and you want to access that money, or when you are leaving employment and you want to access part of your pension, you are tax free without tax advantages. Any contributions made to a pension scheme is contributed without any tax. Whether you're sending via M-Pesa, it's a bank checkoff or employer checkoff, a standing order, this amount is deducted and goes to the savings without any tax being deducted. So there are quite a lot of savings in terms of taxes when you are saving into a pension scheme. I'll just tell us what happens when you're withdrawing and what taxes apply when you are withdrawing. Currently, the good thing is that when you've retired and you're beyond 65 years of age, and you've been saving to a pension scheme, whether it's 20 years, 30 years, 15 years, 10 years, when you exit retirement or you want to get your pension funds, you get your taxes at 65 years tax free. The law passed that effective this year. I know it used to be there before 2020 when it was stopped, but currently you can access your benefits at 65 years without any taxes. So you can decide to save without taxes and access without taxes at retirement beyond 65 years. Moving on. So longevity in old age. So at retirement, with the improved medical facilities in the country and improved research around medical, we tend to live longer than our parents used to live initially. We might argue this, but looking at the trend and looking at these advanced countries like Germany, like the US, France, you realize that their medical equipments are quite improved, and they even have more of old age than they have with the young age, because the medical very much improved, and it tends to make people live longer. So if you're going to live for more years than than the ones that you worked. Let's say you live like our late president Daniel Moi, he lived up to 94 years. That means you're living almost 34 years longer after retirement of 60 years. How will you survive in that period when you not saved enough for that retirement? In terms of mortgage guarantees, the pension law allows us to acquire 40% of our pension savings and take a mortgage with our savings up to a limit of 7 million Kenyan shillings. So whatever you have in your pension fund and as savings, you can access 40% of that up to a limit of 7 million Kenyan shillings to acquire a mortgage. That's a ready house that is ready for occupation and be able to sustain you so that you also have a house even as you continue saving for your retirement. These are just part of the benefits or things that you get to enjoy when you're saving for pension. Even as you say that you not really need pension when you're retiring, maybe you'll have a company or a business, or maybe you have enough, let's say, resources in terms of your savings, in terms of your maybe houses you build houses to sustain in terms of your retirement. But then, how well are you prepared in terms of your housing and what you are supposed to eat in terms of supporting you when you're retired? So these are just basically what benefits that you get when you're in a pension scheme. Moving on, Simon. You can just move to the next slide. In terms of fallback, also when you lose a job, pension law allows you to access part of your contributions, sustaining in retirement. So as I said, these are the types of schemes that you're able to join in as a contributor. There's the state pension, that's for public servants. There's the public service superannuation scheme currently, that every public servant that works in the country, they get their savings from that. So the state pension is the one that is given mostly to the government officials, including even the president. If you happen to read the newspapers this year, President Uhuru Kenyatta received his state pension as having worked as a president for the past 10 years. Then you're able to save under an occupational scheme. If you're an employer or you're an employee, you can save with your employer. Be it that the employee is saving alone, or maybe the employer is saving and the employee matching whatever the employee is saving. But it actually gives you an avenue to also be able to save for your retirement. So an umbrella pension scheme, for an umbrella pension scheme, it's an established scheme that accommodates very small employers be able to contribute for their pensions without setting up an occupational pension scheme. And then if you're a business person, you're someone doing your own investments, doing your own businesses, you're also able to set up a personal pension scheme. That's on the far end. Set up a pension scheme with a provider of your choice and be able to start saving your pensions at a rate that you are actually comfortable with. Good thing with pension savings is that there's no penalty for savings. You're not penalized that because you didn't contribute this year or last year, you are penalized. Not really, but you're able to save without necessarily having to be penalized. So whatever amount you are comfortable to contribute, that is what you're able to save to your pension scheme. So there's no limitation to what you can save under pension. Seems like I lost the slides. Maybe I'll just talk through. Okay, Caroline. For those with pension schemes, there are several options given by the pension scheme on accessing the funds. Kindly attend us on these options, e.g. lump sum and monthly, and pros and cons of either. Hillary wants me to talk about drawdown, so I'll just go through what we are talking about. So, Caroline, in terms of pension schemes and the one that you have with your employer, God forbid you lose your employment, the government allows you to access 50% of that savings to be able to sustain you before you get the next job. So whatever you have in your account, 50% of it you access as lump sum without taxes, and then you're able to help you sustain in terms of retirement. Should you be lucky enough to continue saving until retirement, there are two options when you're retiring, depending with if you are in a pension scheme or a provident fund. When you're in a pension scheme, at retirement you can only access a third of your pension as lump sum. 2/3 you must buy a monthly pension, what we call an annuity. If you're in a provident fund, whatever amount you have in your account will be given to you as lump sum, less taxes. Now, the good thing with buying an annuity is that there are no taxes towards it. You will get your money without taxes, and you get a monthly pension in terms of monthly remittances to your bank account until you retire, until God forbid, until you die. So what I'm saying is that your employer or yourself, you're able to access that amount as lump sum minus taxes. Now with annuity, I said there are no taxes to it. So if you are getting, let's say you have 1,000 shillings as lump sum, if you have 1 million Kenyan shillings in your account at retirement, for example, 1% of 1 million is what you get as your monthly pension. That's 10,000 Kenyan shillings per month. God forbid until you pass on. When buying an annuity, you can either choose to have a guarantee period or not have a guarantee period. If you have a guarantee period, it means that if you take, for example, a 10-year guarantee, it means that you're securing your beneficiaries or those loved ones that you have, that God forbid if I die before my 10 years guarantee is over, then my balance should be given to my beneficiaries. If you outlive the 10 years guarantee that you've put on the annuity, then God forbid there's nothing that will be paid to your beneficiaries. But we advise that you actually take a guarantee period so that you're able to secure your beneficiaries, so that you also get something when you, God forbid, when you pass on. But the good thing with annuity is it serves you for as long as you live. Now you can decide to either buy an annuity or buy an income drawdown, like what Hilary has just touched on. So if you're buying an income drawdown, we really advise that you buy using a larger amount of money. You must have something close to 5 million Kenyan shillings to be able to buy an income drawdown. So difference with an annuity and income drawdown is that an annuity, you take your money and you give it as a premium to the insurance company to pay you monthly pension. For income drawdown, the money is invested and the investment is subject to market returns. So income drawdown, the bad thing is that God forbid the market performs poorly, you can get a negative return on your money. So you draw down part of the money, let's say 10% or 1% of the money every month for 10 years, and then the balance you are given as lump sum. But even as you draw down, the money is still being invested and still earning a return. So after 10 years, you're able to get your money as lump sum, whatever is the balance after 10 years. That's in terms of income drawdown and annuity. Unless you have any other questions, I'll take them. But I think I've answered Caroline and also Hilary in terms of income drawdown. So Hilary will share the slides after this. I will change and then I'll be able to share with you. So in terms of investment, you can not only save for retirement through a pension scheme, but if you know the good thing with pension that you can't access that money until retirement. So you are really saving for that thing until retirement. You are able to choose your beneficiaries so that God forbid if you pass on while saving, what will happen to that money? Who should get it? You should be very keen when joining a pension scheme that you feel that nomination of beneficiaries form. It's a requirement by law that you nominate your beneficiaries, that your money doesn't have to go to the government as unclaimed financial assets. If you are prudent enough and you trust your instincts and you trust that you won't touch that money, you can save through a money market fund. What Simon has just asked me to share about. So money markets works very perfectly and they give quite better returns. But this money is at your disposal. You're able to access it and you're able to withdraw it at any time that you want to withdraw it, which is something we discourage in terms of those people who don't trust themselves in terms of accessing this money. Because if you have this money and you get an emergency that you really need the money for, you will be able to access it. But the returns are quite good in the industry. If you've been checking the money market and the trends, the returns are very good. So the money earns a return monthly, and it's compounded. If you want your dividends given to you, you can also be able to withdraw them, but you can also be able to leave the money there to earn a compounding interest in terms of savings for money market. Very other very good options are like SACCOs. If you save money in a SACCO, and SACCOs give very good returns. For instance, if you are saving your money under the SACCO with the shares, I know most SACCOs give a higher percentage or a higher return every year on shares more than on deposits. So if for example the deposits are giving, I know I'm a member of Muhasibu SACCO in Kenya here. So if you have your deposits there, a return could be maybe 12% dividend given to you every year, but they give as high as 25% interest on shares. So shares under SACCOs can be a very good savings strategy also for in terms of your retirement. You can save your money, but buy shares more than giving deposits. I know with deposits you're able to access a loan from the SACCOs. You're able to access a loan depending on the SACCO, either 3 times or 4 times or 5 times of the savings. But it's also quite a very good avenue in terms of savings and be able to support you in terms of putting some money aside to support you for that old age. Now, we advise members that at retirement, please, if you've never gotten into business, you've never done business before, and you're getting your retirement package of let's say 10 million Kenyan shillings, 100 million Kenyan shillings, 1 million, at retirement, kindly don't take that money and start a business when you've not done a business before. Let's say you began your business at 40 years and you're retiring at 50 years, and your business has really picked up and you want to boost that business using your money. That's quite advisable. But as well as say in investments, never put your eggs under one basket. You never know what might happen. So if you have 10 million, for example, 10 million Kenyan shillings, take half of it and boost your business, but the balance, please buy a monthly pension so that you're able to be sure that like I was used to, every month I'll be getting a coin into my account, whether my business does well or poorly. But never take your lump sum amount of 10 million Kenyan shillings and put it into a business, whatever. Please never take that risk, because this is the last amount that you are receiving at retirement. There'll be no other money coming to you at any point. So you really should make a very serious decision here. It's not a matter of taking chances. It's not a matter of taking chances and also maybe betting, but you should be very sure of what you're doing. And from my experience, and now that I've been in this industry for 4 years and 5 years, we've been giving people pension, and we've been training them before they take their money home. But after 2 years or 3 years, you get people coming to the office and they're telling you, is there any amount that remained here? Kindly. Because they took their money, you went and bought matatus and put them on the road. Luckily enough, or unlucky enough, the matatus never worked out. The police, you know how they do matatus, they keep taking money from you every now and then, and the business can really be frustrating. And God forbid if you have your money under this and the investment doesn't work, you know what happens to you now? You remain a dependent, you get stressed, you really it's very much frustrating. So from my point of view, I'll advise that you take a monthly pension and take part of the money that you have, only a little portion, to put it under investments, but also have it in either money market fund which earns an interest, but please don't take it into a business that you've not done before. If it's a business that has been working for you for more than 5 years, we advise that you take your money there to be able to boost it so that you grow your income pot. Let's just move to the next slides. I'll be very quick because I've talked about most of these things. Yes, I've talked about provident fund and pension scheme. As I said, for provident fund, you get a lump sum. As for pension, you'll get a third as a lump sum, and the 2/3, it's a must that you must purchase a monthly annuity or buy an income drawdown, which I've also talked about. Next slide, please. Next slide, Simon. Why save for retirement? Next. So I said for Arthur is at 60 years. The employer is telling him, you know what, Arthur, it's time for retirement. At some point you have to retire. So what plan do you have? I know some of us start a side hustle that works for us when you retire. Some of us even try starting these businesses and they don't work anymore. So as I said, if you start business and it didn't work, if you have saved and you not have enough, kindly, you know, an employer at 60 years will have to let you go, whether you like it or not. What are you doing about something for retirement? So here is after he's beyond the age of retirement, but he doesn't want to go home. Why? Most likely is because he doesn't have enough savings in terms of retirement. So he's being pulled out of his desk to go home so that they can also make new hires. And we've seen the Kenyan industry is very serious in terms of we have very many unemployed youths who are very much qualified. So we advise that when you get retirement, please let's find our hobbies, let's find what we can do, and let's have enough in savings so that we able to go home and let the next generation also take over and support in terms of building the nation. Next slide, please. Moving on. Simon, next. Thank you. So there's a guy, this guy at 25 years, he's like, I'm too young to think of pension. You know, at 25 years, why am I thinking about something that's coming 60 years to come? No. So every one of us thinks that it's very too early to think about pension, but then so many bills, you have kids, you have school fees on your way, you know. Maybe you have to go in some few loans to build a house, maybe to buy a car. You've just gotten married, you're like, I was thinking about pension when I hit around 45 years. Now, there's this lady at 5 years who says I should have taken pension when I hit my 20 or when I got my first job. So here is you at 5 years, retirement is here, but then you're not prepared at all. And you have only 5 years to retire, but you've not started saving for this pension. What do you do now? You know, it's very much frustrating that at 5 years you're not prepared for retirement. You know, 5 years you either married the wrong person, gotten into so many loans, you have children in high school, children are now just getting to campus. You have so many bills on yourself. You have maybe a mortgage that you're clearing. So it's so difficult for you to start saving for pension when you're at 5 years. And at 75, we see this gentleman at 75 years, he's very old, but he says, you know what? I think I should have thought about pension when I was 25 or when I got my first job. Because he's 75 years, whatever he had saved for pension, he's already exhausted. He's dependent on his children who are not even supporting him enough. So he's very much frustrated. But then the point here is that whenever you have a chance to save for pension, please start saving in whatever avenue you can. Save in circles, save in money market funds, save in a pension scheme. At least set aside some amount that will actually sustain you when you're no longer working or you no longer have an income coming in. So with me here, you can see an example of a savings in pension scheme with a monthly contribution of 2,000 Kenyan shillings, and assuming that the escalation rate is at 10%, you are getting a 10% per annum return. So with an interest of 12,000 Kenyan shillings of 12%, this guy is only saving 2,000 shillings per month. But after 5 years, with the 12% interest, he has 204,000 Kenyan shillings. At 30 years, by only saving 2,000 Kenyan shillings, and you are 30 years, you have, assuming that the interest rate was at 10%, which is mostly the average in the market, then you'll have 12 million Kenyan shillings. If you are saving in something like a money market fund, which gives as high as 12% interest rate, you'll have even more. So what this is showing us is that compounding interest in pension really works magic. If you've had someone in finance say that compounding interest is the eighth one of the world, this is the magic that compounding interest one can work on the money that you save in a pension scheme. So I can share this simulation with you so that you can just do your own calculation and see how much you'll have earned should you start saving now and what amount are you started saving. We have an Excel sheet I can share, a simulation in terms of checking what you will have at retirement if you start saving right now, and giving us a specific amount of money that you'll save, and you're comfortable to start saving at the moment. Moving on. Next slides, please. So the review of pension statement. So this is an example of a pension statement with a member who joined that in 2004 and has been saving. These are only 2,000 shillings, and you can see the balance down there is around 142,000 Kenyan shillings. So depending on how much you want to save, as I said, I'll share a simulation on the savings that you're able to see, and just check with us how much you wish to save and how we can keep forwarding and supporting in terms of saving for this pension. Next slides. So in pension, we have something we call additional voluntary contributions. That even if you said I'm going to give 2,000 every month, and next month you get a pay rise, or you get a deal that really works for you. Let's say you get a consultancy, or you get a training that is earning you extra money. We call that additional voluntary contributions. That it's tax efficient. This amount comes with without any taxes, and it helps you to boost your retirement income. And this money is portable. Yeah, you can transfer your ABC plan to your new employer in case you move jobs, and you can vary. You can stop at any time in pension. As I said, there's no penalty. You can contribute today. You can vary. You can say I'm changing to 5,000 shillings. You can improve. You can lower it. You can say this month I'm not able to contribute. So there's no penalties in pension contributions, and in terms of these savings. In terms of insurance, you can also do something we call we have insurance products that can help you save for up to 5 years. We have education policies, we have endowment policies that can help you save for up to 10 years. I know they have penalties, but if you're in position and you're stable enough, it's good to also take up and take consideration for this pension and insurance product. Next slide. So the purpose of retirement, as I said, these ones help you cover your old age, ill health, and in terms of death, where your beneficiaries are able to get that retirement. So the major aim of saving is old age. But what happens if you get ill earlier than expected, or God forbid if you die before then? As I said, if you get ill, in pension we call it invalidity benefits. If you get so sick that you're not able to work anymore, you get your contributions in lump sum, and you're able to go home and sustain yourselves. And God forbid if you pass on, your beneficiary, as I said, don't join any pension scheme or any investment scheme if you do not have your beneficiaries allocated how much they should get, God forbid, when you pass on. So these amounts are safe, and your beneficiaries will get them pass on. Thank you. Next slide, please. Next. So the structure of a pension scheme. As I said, there are different providers in the pension scheme. We have our fund managers, who are the investors. We have an administrator who keeps the records and manages the schemes. We have the custodian, which I said is a bank who manages the fund. Every pension scheme, be it a personal, occupational, or state, they have what we call trustees. The trustees are the legal owners of the scheme. They oversee running of the scheme, and they serve the interests of the members in terms of these savings. Even for NSSF, the earliest retirement age is 50 years. The normal retirement age in the country is at 60 years. But depending with the employer, if it's an occupational pension scheme, the employer can vary these retirement ages to different ages. I know doctors retire at 75 years. even lecturers, they retire as late as 25 years, including lawyers. The retirement ages are quite higher than the normal one. So this varies depending on the occupation that you took in as a person, what your occupation is. Thank you. Next slide, please. Okay, thank you. Next. So taxation for pension schemes. There, right. That one. So as I said, the benefits for pension is that there's a relief on pension monthly contributions. 60,000 shillings you earn every month up to 10 years is tax free. And then any amount beyond that is taxed as per the bands that you can see on the next slide that as level 3. So the first 400 shillings is taxed at 10%, then 15% for the next 400, 30% for the next one, and then any amount beyond that is taxed at 30%. So above 50 years or more than 50 years in the scheme, benefits are subject to higher tax bands, and any unregistered or tax remitted portions are not taxed. So for pension, any contributions up to a limit of 25,000 Kenyan shillings is not taxed, but any amount above that is taxed at a payroll level. And any amount above that 65, as I said, is given to you tax free. And any transfers to any pension scheme, you can transfer to any provider that you want. If you have a pension with a provider and you want to transfer to another one, the transfers are done tax free and no charges at all to the transfers. Should you transfer to any next provider? Let's move to the next slides, please. Next slide, next one. Let's go to the next. Next one. Okay, I think I didn't see Hilary's question here. If one left employer to another employer, what happens to employer contributions in the previous law? Assume he has taken 100% and 50% of the employer. Okay, Hilary. So in this case, if you had accessed 50% of your contributions and 100 of your contributions and 50% to the previous employer, whatever amount you have or you can transfer it to a personal pension scheme that we've just said about. So when leaving employment, kindly, when you're leaving employment, we really advise in pension that you move with your money. If you left your money at the pension scheme, or transfer it to your next employer who has a pension scheme, so that you are not able to leave your money behind when leaving employment. So I think I've answered that, Hilary. If you are satisfied, please follow up with that. Or move it. So you can be able to, because you cannot contribute to an employer to assume that that's how it works. So this is models of access and income replacement, as I said. So in pension, we say that the income replacement ratio when you're retiring should be at least 70% of your last salary. So God forbid, if you say you earned 100,000 shillings as your last salary, then at retirement, when you're buying an annuity or an income drawdown, it should be 70% of what was your last salary. So if you used to earn 100,000, then 70,000 shillings is an advisable amount that you'll have at retirement. 30% we assume it's the expense that you used to spend at lunch, lunch at the office, the travel allowances that you used to have at the office, those amounts that you used to spend on the road when you are going to office, we assume it's at 30%. But for you to be able to live the life comfortable that you used to live, you need to have 70% of your savings as pension when you're retiring. In terms of drawdown, there's a capped, flexible, and fixed term annuity. Those we also able to advise you in terms of as I talk about income drawdown, that you are able to draw down part of your money as savings, but then the balance you'll get it after 10 years. Thank you. Next slide. So yes, these are the options in retirement. You can end up take a mortgage, you can take a lump sum, you can put the money under investment option that you choose. You can have
From your voice immediately.
Yes.
Yeah, now it's clear.
Yes.
Your audio ilikuwa imedim kidogo, but now it's clear.
So you can choose a mortgage, a lump sum, investments, annuity, income drawdown, and then we have what we call a post-retirement medical cover. So this post-retirement medical cover, when you at retirement, the biggest challenge you have is medical. So you can use part of your pension, part of your savings to buy a post-retirement medical cover, and that the premiums for this medical cover will be drawn from your fund that you saved for post-retirement medical fund. So which way do you use as a retiree? You can decide to choose whatever these options that you have here. These are the options that you have at retirement, so you're able to select and choose them, subject to advice from experts in the industry. Thank you. Next slide. You can have the questions on the chat. I'll be able to see them and respond to them. Yes, Hilary, I'll share the Excel for you to be able to support yourself in terms of tracking your retirements. We'll share the Excel sheet with you. Yes, next. Next slide. Yes, so benefits at retirement. So very few retirees live comfortably. We have 31% that are working. As you said, we also need to work at retirement, so that you don't just go home and then not really continue working. But you should keep your mind active and your mind at work. So even as you go to retirement with your money and the funds that you've saved, you should plan to do something that you do. So only 30%. The industry says that only 31% of retirees actually are working. 6% are a very low margin. 6% are the ones that are only financially independent. They can live without support from anyone. 16% are dependent on pension. That whatever they saved is what is serving them at currently. 16% only. So which means that we need to up our game in terms of savings. And the highest percentage is 47% depend on their relatives and their friends in terms of survival in their retirement. I know our parents grew up knowing that we are the retirement solution back in the days, but looking at this generation kindly, please just sort yourself out. Please save for your retirement, because this current generation will not actually be there for you at retirement. They actually will want you to support them in terms of you, instead of you supporting them. So the highest percentage is 47, depending on their relatives. So kindly, let's just save more. Let's get into more avenues of savings, so that we actually can improve this yellow margin of financially independent people. 47% of people that live comfortably in terms of retirement. So I'm guessing we can have any questions. If we have, kindly, so we just move answer up to that point? Okay, yes, please. The previous slide, the one for business. That one, thank you. So you see, this is a lump sum benefits utilization in terms of business. So you can see 21% of business began by pension money collapsed. 21%. You took your money, went home with data for retirement, but then you began a business and it collapsed. 31% are operating at profitability. Probably these are people who had their money, already had a business that was working, and they put part of the money as a boost to the business. And then we have 48% who have begun businesses that are actually unprofitable. You began a business with your retirement money, but it's not earning any profit. So which means that you are simply, it's a leaking basket. You put your money in a place that is not really earning any return. It's just leaking out. You are paying bills, you are paying rent, you are paying employers, but then there's no profit coming from it. So this just shows us that unless you're prepared for the business, please don't venture into any business that you want to do at retirement. Unless the business is stable enough and you saw that it actually giving you a return, then you can boost it. But if not, please don't take your money at retirement to go and start a business that will not actually work, because this is what we have in the market and this is what we've analyzed over the years. And we advise that you don't take your money and start a business at retirement. This is on a very light note. I know most of us think we can do business, but it doesn't work. It doesn't work for everyone. If you can go around asking how many people have begun business that fail, I know many don't talk about it, but so many businesses fail every day. Let's be very keen with how we manage our retirement funds. Thank you. Very quickly, we've talked about annuity. Next slide. Yes, we've talked about annuities. Let's just move to the next. The process, yes, we've talked about annuities. We've talked about income drawdown. I think we've all known what income drawdown is, and we've talked through it. Let's just move to the next. Post-retirement healthcare. We've talked about post-retirement healthcare. We can just go to the next slides. Nomination of beneficiaries, as I told you, it's a requirement by law. And by the way, benefits of pension are not part of a deceased estate. So no one can take your money to court and say that my father did not put me on his benefits as pension. They're not part of your estate. Whatever you choose as beneficiaries is what will be given, or those that will be given your money at retirement. It also gives you a peace of mind as a person that my money will be safe even if I'm not there. It eliminates unnecessary delays in payment. So if you have savings but you don't have beneficiaries, at payment it becomes difficult for people to know whom, and God forbid when you're no longer there. So it also assists in making decisions that at retirement they know who should take this money home. Thank you. Next slides. So as I said, enjoy your life at retirement. Retirement is not. Thank you. Back slides, previous slides, please. You can go slow here. We are almost coming to the end. So retirement is not the end of life, but rather a beginning of an exciting experience. You're going home with no supervision, no one to follow you, no one to send reports to. You're going home to relax, but with your money. So if you are well prepared and you have a place that you can go to and you have work to do, it will be very enjoyable. And if you have a loving spouse, I know. Some of us made the wrong choices, but yes, if you have a very good spouse, you will be very safe at home at retirement, and then it will be the best experience that you'll ever have. And we advise that you should live longer than you've worked. You've worked for only from 25, let's say, to 60. You worked for that 5 years. You should even live up to 40 years after retirement. So basically, if you plan very well, you should live up to 100 years beyond at retirement, unless you just get too old and you want to go meet your maker. So retire happy and live happy and plan your finances quite well. Next slides. So make retirement the best years of your life. How resilient will you be in retirement? You know, this is a flower, and that's a couple at retirement. So at retirement, you are a flower that has worked for all these years. You know, this is a flower flourishing in a very dry area. That's how retirement looks like. Now, if this flower lands in this dry area with no water, with no manure, with no support, no backup, how will this flower survive anytime soon? This flower will be dead in the next 2-3 months, 3 years, maybe 3 days, worst. So at retirement, if you have enough muscle in terms of your savings, you have enough preparations, you'll be that flower flourishing in a desert with your own, water to water yourself and support to have. If you retire with if you retire with a very supportive partner, you'll be safe. If you retire alone, and you're prepared with it for it, you'll even be safer. You know how to manage yourself. You can hire people to support you in terms of this retirement and how well to support you live longer than you expected. So retirement is a journey, and that we should not be scared. Let's just prepare well for it, and we'll all leave this place a very happy people at our retirement age. Is that the end of the slides? Do we have any further slides? I guess this should be my end. Yes, thank you. That's it. So planning for retirement, you plan. You have to manage to, balance your career and life. Midlife crisis. Most of us don't get to manage our life and our career. Exercise enough, in terms of your finance, in terms of your body. Prepare yourself so that you do exercises. You do enough walking, and you'll be able to enjoy and swing like our guy here. Because your life is sorted, and you came in retirement prepared. So this is it. Next slides. Previous one. Let's just see the previous slide. Second last one. You see? So this is a cat looking itself in the mirror, and it is a lion. The cat is looking itself in the mirror, and it is a lion, because it's unbeatable. It has, you believing in yourself. How well or how very serious do you believe in yourself in terms of God forbid you lose your job today, you lose your job tomorrow, you lose your job in the next 1 year. How prepared are you that if you lose your job, you'll be able to sustain yourself for the next days as you look for the next job? Now, how well are you prepared even at retirement when you're told you have to go home, that you can no longer work, you have to go home and rest? Will you look yourself in the mirror at retirement and say, I'm the lion and I can survive this because you have enough, you are well prepared for this and you can do this better? That I leave it to you. So I wish us all the best as we prepare for retirement, and I wish us even as the best as we manage our finances, and even as we save more in our post, that we should be able to save way more than we are consuming right now, so that when we need it the most, it will come through for us. I think that's it. If you have any questions, we can just check them as we close on this. Please, they're saying you should get your webinar CPD certificate using the form attached. Check on this on the chat so that you're able to see and get the unique code to get the CPD certificate for this webinar. If you have any questions, I'll take the program back to you, Simon.
Thank you, Abraham. I think that has been a very informative session, and for all the participants who are full time, I know you have gathered a lot. For those who have logged out, maybe due to internet emergencies or commitments, I hope they'll be able to go to our YouTube channel and watch the session again so that they can get the concepts they might have missed out. So thank you, Abraham. for your delivery to our clients. And thank you to all clients who have been able to join this session. So I've shared the link to get the certificate from our website. You just fill the form, the details that will appear on your certificate. If the link is not yet found, give it a few minutes. Like next week, we'll be having another webinar on matters tax. So if you will allow me, I will maybe just share the link right now so that you can use this time to do early registrations on the STEM. And then we hope to meet you again next week. Just give me a second as I get the link for that. Give me a second. Getting the link for that.
Thank you. Simon, allow me to change the slides to edit and then share very creative slides with you so that you're able to share with the clients later on. Otherwise, thank you so much.
Sure. Yeah, thank you. Please help us get the slides and then we can share with them a good copy. So next week we'll be looking at Finance Bill 2023, and we'll basically be looking at business and social implications of the proposed tax recalibrations. So I'm sharing the link in the chat section. I'm just copy pasting it. It's a session that will share with us things that affect us directly when it comes to matters tax, and of course with the current regime. Yeah, so I've shared that we'll be having it next week on 17th. So you can click on the link that I've shared to make an early registration. Otherwise, thank you for joining us, and I hope to see you in the next session. I don't know if we have any questions. I'm still checking the chat section to see if we have any questions for our trainer. If not, I think we are now at liberty to switch gears and engage in other personal schedules for the afternoon. Being no other questions. Okay, so thank you, Abraham, and thank you everyone for joining us today. I hope to meet with you again next week. Thank you.